Keith Buchanan, Senior Portfolio Manager at Globalt Investments. Keith, always great to see you. Thanks very much for joining us.
Thank you.
What was the most interesting thing in the markets for you today?
Well, thanks again for having me. We've been drinking from a fire hose, which feels like the rest of the market is as well. With the news flow from a monetary, fiscal, and even earnings standpoint, it seems to hit a fever pitch over the past week or so. Today has been somewhat of a lull in that. Chairman Powell's testimony really didn't bring any new news to the marketplace. But there's still a laser focus on several areas that could really impact the next direction of the market over the next several weeks. And we're remaining very focused on just how all of this collision of all of these stories could impact the market direction.
I mean, there are suggestions that these tariffs initially could damage American companies rather than foreign companies because it would increase their input costs.
There's absolutely a prospect in a lot of academic literature that supports the fear of the tariffs actually bringing, importing inflation into the U.S. And there's a shouldering of tariffs that happens on the part of the tariffee, if you will, or the tariffer. And that, again, there's a lot of debate around that. But there's still no question, a lot of fear around whether or not the inflation, the tariffs that have been proposed, if they go into action, will they impact our inflationary readings? And also, how does that impact where the Fed goes and the reactionary function that seems to be endless at this point? But the first direct reaction is how does the Fed navigate 2025 if there is a recipe for a resurgence of inflation? And do they get in front of that inflation before it hits the readings like we saw earlier today with a little warmer inflation than was expected? The Fed is really in a tough spot, and Powell today and yesterday seemed to make sure he gave a lot of room to the notion that they will be patient with the Fed moves, especially cuts going forward, as the market has started to expect maybe one cut, perhaps two this year, or perhaps not any as we move forward the rest of the year.
It's interesting, isn't it? It's like I'm thinking about moving out of a house or an apartment or something. It's okay at first, but you come down to those last few things. What am I going to do with them? Something your grandma gave you or something. And it's a bit of an elaborate analogy here, but actually dealing with inflation, getting to the end of the road has proved tough.
The last mile historically always proves to be the most difficult. And right now we're right around just north of 3% on pretty much any inflation reading, thereabout. So still another 100 basis points from the Fed's stated target. The tariff conversation couldn't happen at a worse time for the Federal Reserve, because now that we have turn of the year, there's already pressure and just a historical standpoint and habit, if you will, of corporations to push through any price increases that they feel coming over the next 6 months at the start of the year. So we have that element that actually puts upward pressure on any January inflation readings, while you have tariff negotiations and back and forth that's going on between our administration and administrations globally. And that complicates things as well. If there's a corporation that's fearful of higher input costs, perhaps they might raise prices to get in front of it or do things on their end, which in itself, again, that inflationary mindset, that could actually cause inflation itself. And it's almost a self-fulfilling prophecy, as those that expect inflation almost promise it through their actions in preparing for that inflationary pressure. So all that's at play at once, and it makes the Federal Reserve and the Federal Open Market Committee in a very dubious position in that they don't like to front-run inflationary readings, but they also don't want to be looked at as getting very far behind, as of course, the last couple of years proved that perhaps they were a bit behind the eight ball. So it's a complicated position they're in, and every eye in the market is watching them very closely.
How are you playing big tech, Keith? Do you have a view on it? Are you worried about perhaps that AI is going to be cheaper to implement and develop, and some of this big spending may have been wasted?
Sure, we absolutely have a view. You almost have to, because there's so much a part of the lexicon and the market cap of any index that we're either implementing for our clients or trying to compete against. We've looked at the past couple of years as growth being the preferred habitat. And as 2024 wore on, we looked at a dislocation as a bit of a risk for the Mag 7 AI-driven names that perform the best. Now coming into this earnings season, further into 2025, we see that earnings growth that the market is expecting around 14% in 2025 to be now it's spread out among names in the other, 493 in the S&P 500. That offers opportunity because of the valuation gap to get more involved in those names that have a propensity to drive some of that earnings growth and free cash flow that those companies can generate, which are more household names that aren't necessarily the NVIDIAs and Apples and Microsofts and Palantirs of the world. We're finding value, and those stocks are starting to reward investors by moving in a very dramatic way. And frankly, in a way they haven't over the past couple of years when you compare them to the rest of the market. So we're really excited about what we're finding in the U.S. markets outside of the Mag 7. We're not disbelievers in the AI revolution and what productivity it could drive and how it could revolutionize almost every facet of our lives, professionally and personally. We feel like the price you have to pay for those names versus the rest of the market offers opportunities in the rest of the market rather than the Mag 7 right now.
Keith, thank you very much indeed for joining us.
Absolutely. Thank you.
Keith Buchanan, Senior Portfolio Manager at Globalt Investments.